Hello and good morning. My name is Preston Reine. I'm with IHS. I spoke last year at the Economies Chicago, and so I'm excited to be at this one this year. Highly recommend getting to Chicago. I spoke last year about some motor market trends, and I'd like to provide an update. If you saw the presentation from last year, there'll be some similar discussions, but I'm happy to go in more detail into that. A little bit about IHS. We are a market research and consulting company, and so I'm not nearly as technically focused as a lot of you are probably, but one thing that I do provide are industry statistics that help a lot of companies like yourselves and even your customers drive their business, know what their market share is and what kind of trends they need to be ready for in the future. So before I get into that, I'd like to kind of update you on what the general economy looks like from our perspective and what that might mean for your business, and then get into some of the more key trends, specifically looking at the motor market. And so my group is I'm senior analyst and manager for manufacturing technology. I look at a lot of capital equipment and electric motor systems. We've got analysts all over the world and dedicated economists, and so we've been working really closely on broadening our expertise, and so you'll see a lot of that. And so currently, right now, I'll just jump into it. There are systemic factors and structural factors, of course. What we have going on right now, though, is a system that is really it reverberates from one area. So for instance, I'll talk a lot about overcapacity concerns. I know that that's an issue in China right now, the labor force issues. These are all coming into play with each other. So the falling commodity prices is a result of a lot of overcapacity concerns that we've had over the last couple of years. And then what that means is, with all of the political unrest, commodity price tanking, there's a lot of just risk aversion, a lot of unwillingness to invest. And so we've seen trade deficits in a lot of key economies, as well as just a general lack of investment and production. And so this one isn't too exciting. It's just how GDP is. We track GDP and machinery production, a lot of that. The point is that if I showed you this chart last year, those last few bars would be a lot higher. And so basically we've been tempering expectations for a lot of the reasons that I've included in that previous slide. Basically, though, we're looking at a lot of flat performance and a lot of uncertainties, and so that tends to not really bode as well. But what we've been seeing is we've been looking at a lot of the emerging economies. We know that the U.S., the Eurozone, it's had its issues, for example. But clearly, Russia and Brazil and Latin America really, when you look at their growth, and this is just GDP, but when you look at their industrial production in general, it's a very similar trend line. That's why I'm using GDP here. It's very different. And then even by China and India's standards, we've seen a little bit of a change there, although they're very different. India recently committed to electrifying as many villages as possible by 2019, I believe. And then China, there's still all kinds of questions as far as what kind of economic development we can expect in their plan, and how are they going to get mining activity to start up again, because that's still really the biggest issue that kind of echoes into the oil markets, steel markets, and then as that happens, for example, the turn down in the steel market in China has gravely affected the U.S. market. And that's really caused a lot of concern for jobs in the U.S., for example, and what kind of effect has that had. Now, and looking at China specifically, basically a crisis has its challenges and its opportunities, is what I wanted to highlight here. But if you look at the green one, machinery production, that's for a lot of the equipment that we're looking at. So motors would definitely be included in here, going all the way down below zero to in 2015, 2016. And so we're really not expecting a big increase in the next couple of years. And why that's important is because China accounts for over half of the motor market in the Southeast Asia region. And that, of course, has a big impact on trade. And so if we look at the industrial automation equipment, so that's motors, motor controls, automation equipment, and other types of power transmission equipment, for example, discrete sector activities. That's something that we track very closely in order to better understand why the markets that we serve are doing what they're doing. So they're very similarly sized from a revenue standpoint. If you look at unit shipments, motors would make up a very, very small percentage of that, but that shows that they're a very key economic driver in this section. And so if I had shown you this figure last year, a lot of these numbers would be a lot higher than what they are now. So we've really had to temper expectations. We've really had to put a downward spin on our forecast for a lot of these products. For example, in Germany, a lot of motor suppliers that we talk to have been reporting as much as a double-digit negative growth this quarter, year on year. For most products, especially motors, you would expect a similar revenue allocation, similar to this. When you look at the general IAE market, that's industrial automation equipment, you can see that Asia Pacific and the Americas still have a lot of good growth opportunities if you look at CAGR from over the long term. But really, the European market is a lot of the reason why it's not maybe growing on par with the other regions. And then if we were to look at maybe an industry sector analysis, if you look on the left here, the growth lines are a lot higher. These are a lot more discrete sectors, machine tools, food and beverage. These are all areas that have been largely unaffected by oil prices, for instance. And then when you look at oil and gas and mining for last year and for this year, the growth prospects were not very auspicious, let's say. And that's important to understand because I'll talk a little bit about what kind of strategies and how competitive some of these markets have gotten. And so really a lot of the motor suppliers, for example, that have been historically heavily involved in power, oil, metals, and mining, they're really transitioning to get into more of a lot of these applications. And that's important because that's, of course, it's bringing all of that price competitiveness into those discrete sectors as well. And so we're seeing a lot more competition. And so in general, while those markets have a lot of growth, it's really hard to gain market share right now, which is really what a lot of companies are focusing on. This might be hard to read in the back, I'm sorry, and I'll go over this one really quickly. If you look at the foreign exchange effect for Germany, for example, Germany and Japan at the top there, in 2016, basically the euro and the yen have really weakened so much to the extent that it had I think roughly 16% effect on that. So while the euro definitely, the market in Germany declined certainly, but when you take into account the currency exchange rate, you're looking at almost negative 20% growth when we present it in US dollars. Why is that important? It's just important to know because it really it's been harming trade essentially, of course. But the economic effect of that is that we've seen a lot fewer investments. It's good for Americans right now. You've probably seen a lot more tourists in Europe, probably for that reason. But generally, it's surprising. A lot of the larger companies aren't as affected by it as much because they have purchasing agreements and it takes into account the exchange rate. But a lot of companies have also gotten to contracts and locked in a certain rate, and so as commodity prices have been going down, it's really been harming them, and it's really been a tough struggle to remain profitable in this market. Okay, so I'll delve more into the actual motor type data now. Um, so most recent data, if we're looking from 2015 to 2020, when I say the EMEA region, that's Europe, Middle East, and Africa. That's the slowest growing prospect for us. The top leading suppliers are, of course, ABB, Siemens, and WEG. I'll have a table highlighting more of the market share players in a couple of slides. Um, but really, we can still actually see a pretty steady amount of investment in the Middle East, and the break-even costs allow oil production to continue in the Middle East, and so we're actually seeing continued production there, of course. But in Europe, with all of the political turmoil going on, the potential United Kingdom leaving the euro, and then oil prices in the U.S. Also, it's really not leading to a very positive growth prospect for these markets. And so a big thing that we look at and what effect this has on the motor market is how do efficiency regulations have an impact? What can that possibly mean? And so I'll talk a little bit more about that, but I just wanted to highlight that each region has its own different focus at this point, and it's had varying levels of success depending on what region we're talking about. The U.S. is about to pass another phase of its minimum efficiency requirements for electric industrial motors. And then the Eurozone passed its next phase last year in 2015, as well as Japan. And so if we were looking at the impact on the forecast of that, you'd see almost parallel growth with IE2 and IE3 motors. And that's to be expected as there are a lot of transitions, but there are a lot of counteracting forces. For example, fewer IE2 motor efficiency, and so basically when I'm saying IE1, IE2, IE3, I don't know if that's a common term, but that's referring to the efficiency ratings for the electric motors. But basically, Brazil starts phasing in IE2, and the U.S. starts phasing IE3, so you can still see a lot of growth and maybe some of the lesser efficient ones. It's a complex model to really put together, just because you don't always know how effective one country is going to be at regulating these standards. But what we've seen over time is that essentially it takes 3 to 5 years for a policy to come into effect, for it to be adopted. One issue that we try to track are potential loopholes. So if you are still selling old inventory for the next 12 months after a policy comes out, that can definitely hinder growth of the higher efficient equipment. So who are the major players right now? Well, it's no surprise that a lot of the companies that as being, more advanced solution providers, they are advertising the IE4, IE5, maybe even motors, stuff like that. When I talk about major players, I'm talking about typically more than a 2% share of the market. ABB and Siemens have a pretty considerable share above that. And then WEG is a close third. But these are all companies that we track very closely, as well as even the smaller players. We have analysts in China that have been following that, and so we build up a bottoms-up model. And so when I give you data, it's from a lot of the estimates that we're assuming with companies like these. So I was talking about the time it might take to implement maybe full compliance of a policy, and I think that 3 to 5 years is actually pretty generous a lot of the time, because a lot of the things that we've been seeing, especially in Europe, I know it's a big issue. Countries like Turkey especially, suppliers will talk about how there are still less efficient motors being sold. There are ways to get around that, and so it definitely makes it difficult not only to track those sales, but also to move forward. And companies selling higher efficient equipment, it's more expensive, but low cost suppliers are still very prevalent in the market. But one thing you'll see is there's a big focus on IE4, like permanent magnet type of motors, and they make up a very, very small percent of the market. But they're actually growing at such a vast rate, like high double-digit growth every year, year on year, but it's still such a small percentage of the market. I think it's a $70 million market right now, the IE4 market. Mostly synchronous reluctance there. It's good to kind of look at world shipments, but when you look at it at the dispersion in different regions, it tells a much better story, I think. If you look at IE3 sales in Asia Pacific as opposed to the Americas, for example, very, very clear difference. It's just a matter of focus and how prepared suppliers are to do that. And so next month in the US, for example, we're transitioning to stricter requirements, so more motors will have to be attaining the IE3 NEMA premium standards. Whereas in Asia Pacific, there's a lot of countries that still haven't really implemented that. I know India is a country that's looking at that, whereas China has made vast strides in the last 2-3 years. Japan just went straight from IE1 standards to IE3 standards, and that was adopted a lot more rapidly than in a lot of other countries. Like Brazil also took a while looking at the Americas to go from IE1 to IE2 standard ratings. It's important to know, I'm talking to a lot of coil winding experts about motors because that's where the product ends up, and I like to talk to motor suppliers about where their products are going too. I think it's important for y'all to also witness that. Basically, pumps, fans, and compressors are the key applications. And when you look at what kind of growth might be expected, it's kind of similar to the table that I showed you earlier on about the process sectors maybe not doing quite as well. But pumps and fans are definitely growing quite rapidly. Conveyors as well, so material handling, food and beverage, stuff like that, doing quite well. Pumps and fans used very heavily in HVAC, water and wastewater, of course. And so those are areas that are very municipal focused. They're a lot more tied to taking advantage of lower cost of living. So when oil prices go down, you can expect to see maybe construction go up, residential, commercial construction, stuff like that. And then all the others, though, still paint a pretty bleak picture. You look at applications like roller tables, for example, directly tied to mining and steel production. There's just really no there's no near-term positive things to say there. A lot of what's happening, especially when you look at steel, metal manufacturing, and molding, especially in the mining market, we see low cost being the main focus, and so rental equipment is being used rather than new sales, which harms that. And so even as the mining market maybe starts bouncing back in 2018, that's going to delay new order sales until 2019, 2020. So we really don't see a lot of those sectors really outperforming the market for a while. There's good and bad. So kind of what I was just talking about with the last slide. What happens, when the oil prices tank and a lot of industrial investment goes down? Well, disposable income certainly goes up. So we see the construction market, specifically in the U.S., has actually been bouncing back pretty strongly. There have been some headwinds, certainly. But India is very focused on urbanizing rapidly, and we see that a lot in the Middle East. A lot more vertical buildings being built, so taller buildings, more equipment being needed for that. And then in China, that's certainly slowed down, but we're starting to see reason to have good expectations for construction there. On the other side, well, and also I should touch on, we were just talking about the focus on systems efficiency. That's a huge opportunity for you and for your customers and for their customers as well, because well, aside from the benefits of the energy efficiency, of course, I think that more people are focusing on how they can provide a not just a standard product, but a whole solution. And that shows how you can offer the value to your customers. But the low-cost providers are still prevalent, and it's really harming that. So it's kind of like, one step forward, one step back right now, not necessarily not making progress, but it's just, I think a lot of motor suppliers are really trying to figure out how to tackle that market right now. So there's a clear path to, driving profit, growing market share, but there are a lot of headwinds still. So what are suppliers doing to respond to that? Well, aftermarket services and revenues have certainly been on the rise. Most companies have actually been okay with the fact that they realize, prices of motors have gone down pretty substantially. I'm talking large motors all the way down to small motors. And that's directly an impact of purchasing price agreements, customers just saying, hey, I can't buy unless I get a 20% discount. So in a lot of the bigger industries, there have been some really substantial price decreases. So suppliers are saying, okay, well, we're not going to make a profit on our products, so let's start offering services that can make up for that loss. And so that's what I mean by being a solutions provider. When I talk about, they don't want just a motor, that's what I mean. You got to find other components. Let's implement sensors and other technology into this. And so you see a lot of those market leaders that I mentioned earlier, they're very dominant in this. And so the whole Industry 4.0, I don't think that will be a common term amongst, coil windings, for example. I don't know how that would be implemented. I have a colleague speaking tomorrow, though. He actually focuses and tracks Industry 4.0, though, so he'll probably have some better insight into that. I know that a lot of motor suppliers are definitely staying in tune with that, though. And then 3D printing could certainly be the future. That kind of ties into just smart manufacturing. How can we lean out and cut costs as much as possible? So a lot of people don't really realize, why is smart manufacturing so important? Why did Industry 4.0 come about? That's because most manufacturers don't really have a lot of visibility into what's happening in their own factory, what kind of, what's the status of their equipment. A very alarming number of factory managers, they wait until the equipment shuts down, and then they spend a lot of the day just trying to find the replacement for that. So that makes things very difficult, of course. And then, if you realize it's a problem when it's too late, then that's going to, prohibit you from looking at the other, things that your job requires. So, in general, the key takeaway there is, everyone's starting to focus more on systems efficiency. It's really the best hope for a motor manufacturer to gain market share right now. It's difficult without that, and so I think I highlighted, I hammered pretty hard that it's rough economic times right now. There are a lot of reasons to be struggling, and it's kind of reverberating across every industry sector. If it's not affected by oil prices, then it's at least becoming more price conscious because of increased competition. So people are starting to, broaden their sphere as much as possible. There's a lot more overlap with competitors now. So with the shift towards efficiency, Industry 4.0, players in the market, they need to just be thinking about how you can simplify things for your customers. Motor suppliers, like I mentioned, are definitely focusing a lot more on really any way that they could get a leg up in that market. And so I think that I highlighted that pretty well. But Yeah, it's just the motor market is so mature. It hasn't really changed that much over time, and we've seen more change in the last 5 years than we had in the previous 20, 30 years probably. So it's really exciting times right now, but it's also more difficult than ever to kind of stay ahead of the game. So these are the things that we've been following. Please, reach out to me, shoot me an email or anything, or come meet me after this presentation if you'd like to talk more about that. It's something we've been following for the last several years, decade or so. Yeah, so that's all I got for you. If there are any questions, I'm happy to talk more about that.